Nifty Bank Index Fund. Will investing in this NFO help your wealth creation goals or hurt your investment portfolio? Let us see in detail in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decisions and to achieve your financial goals faster and smarter. Now let us first understand about the Nifty Bank Index. This index comprises of the most liquid and large Indian banking stocks. It also provides investors and market intermediaries a benchmark that captures the capital market performance of the Indian banks. The index comprises of maximum 12 companies listed on National Stock Exchange of India (NSE). This index is computed using the free float capitalization method. So this Nifty Bank Index can also be used for a variety of purposes such as benchmarking fund portfolios, launching of index funds, ETFs, and other structured products. Now let us look at some of the features of this fund. This fund opens on 15th May 2024 and is open until 27th May 2024. So the category this fund belongs is to the index scheme. This fund is an open-ended fund type. It has Nifty Bank TRI as its benchmark. So the minimum amount for investment required for this fund is 100 rupees. It has plans for growth and there is no exit load in this fund. So first we need to understand the primary investment objective of the DSP Nifty Bank Index Fund and see if it aligns with the own investment objective. So the investment objective here is to track returns by investing in a basket of Nifty Bank Index stocks. So we can create long-term wealth creation. How do we create long-term wealth creation here? By investing in the securities of the Nifty Bank Index. So this investment objective is really aiming to achieve returns of the stated index, which is the Nifty Bank Index. As it tries to replicate the index, it is subject to tracking error also, which we need to keep in our mind. So now we are going to look at the investment strategy of the DSP Nifty Bank Index Fund. As we have previously discussed, this Nifty Bank Index represents the top 12 banks based on free float market capitalization. This scheme also invests in all the Nifty Bank Index stocks in the same weightage. The index will be rebalanced semi-annually. This portfolio has been specifically designed based on the recent and past performance of the banks. Also, an important thing to consider is for the past 15 years, the index Nifty Bank TRI has outperformed both indexes Nifty 50 and Nifty 500. To understand its investment strategy more in detail, we are going to look at the structure of its portfolio and what kind of securities it has in its portfolio and how much weightage is given to each specific securities. We can see from the screen, if you just pass it, that there are several high top performing banks of India, which are HDFC Bank, ICICI Bank, Kotak Mahindra Bank, Axis Bank, State Bank of India, IndusInd Bank, Bank of Baroda, Punjab National Bank, IDFC First Bank and Federal Bank. And the weightage given to each of these securities ranges from 2% to 29%. So we have an idea how this portfolio is structured now and what kind of investment strategy they are going to implement for this particular index fund. As we have already taken a look at the portfolio, we now understand that this index fund predominantly invests in the banking sector. So now the question remains, are banking sectors worth enough to invest? To find out the answer for this, let us look at some of the positives that banking sector have to offer for us. First is that bank services are now allocated the highest weightage in broader market indexes like Nifty 500 and Nifty 50. And according to Indian Stock Exchange, Indian fintech market is expected to reach INR 6.2 trillion by 2025. Also, the demand for banking and its related sector will be increased due to two main factors, which is the growth of disposable income and also the increasing rate of the working population here in India. So banking sectors also possess high net interest margins and low NPA non-performing assets, which indicates a healthy performance. Also now another thing we can visibly see is private banks have a drastic improvement over the past 10 years. Be it that they have adopted some customer-centric mindset and they're technologically superior to what they were before, at least 10 years before. So these are some of the points we can keep in mind when evaluating the banking sector. As we have looked at the positives that the banking sector have offer for us, Now let us look at some of the pros of investing in the DSP Nifty Bank Index Fund. Especially if you are a beginner investor and you do not have a demat account and you just want to get started with a minimal investment like 100 rupees, then you can invest in this fund as these 2 points are applicable here and will be very convenient for you. Also, another thing to consider is recently the asset quality of banks is improving due to various reforms. Also, as we can see from the portfolio, this fund is diversified among the top performing banks in India. As a passive fund, as an index fund, it has a low expense ratio compared to an actively managed fund. So, this will be suitable for an aggressive investor who are bullish on the banking sector. As we have looked at the positive of both the banking sector and the positive of investing in the DSP Nifty Bank Index Fund, it's equally important to understand the cons of investing in this fund as well. So first and foremost, it may be risky for a short-term investor as this fund applies the principle of high risk, high return, where only long-term investments will be able to get at least the potential high returns. So if you're only willing to invest in this fund for a short term, it might turn out riskier for you. So it's better to avoid. Also, another important thing to consider is this is not an actively managed fund, this is an index fund. So the fund manager here has no control over the individual holdings in the portfolio. They're just going to replicate the stated index. They have no control over the individual holdings. So they have no choice to include or exclude securities in the index composition based on the market trends, just like they will do to a actively managed fund. Here they have no control over such type of things. Also, as it's an index fund, the returns of the index fund can't be expected to beat the market. It can be more or less expected to beat the index fund's returns, but it's not expected to beat the market, the returns of this particular fund, as it's an index fund. So, being an index fund, it also limits its exposure to various strategies. Like, for example, if you choose an actively managed fund, the fund manager will be able to employ a different investment strategy and consistently analyze the market trend, the ups and downs of the market, and see which stock will perform well when the market is down, which stock will perform well when the market is high, and they will be able to play according to the market trends and weakness. But here, as an index fund, it's limited. Exposure here is limited. So, if you're looking to add this fund to your core investment portfolio where you want to achieve your financial goals, then this fund might not be suitable for that core portfolio. Because as an index fund, it may also underperform its index due to fees, expenses, and trading costs. And it's also not flexible or dynamic compared to an active fund and can even add more volatility to your portfolio. So these are some of the most important points to consider before you want to decide in investing in this fund. So now after looking at the features, pros and cons of investing in this fund, what is the final takeaway of this analysis? Whether to invest in the DSP Nifty Bank Index Fund or not. First and foremost, please try to get an opinion from your professional financial advisor before investing in this index fund because they will be able to help you through understanding your investment objectives, your risk profile, the overlap ratio between your investment portfolio and this fund, and see if it aligns just with your goals. They will be able to personalize a financial plan and craft personalized investment strategies according to your financial goals. So, involving a professional in this decision will make the entire process of investment smoother and easier for you. Also, our personal opinion is if you are a conservative investor and if you're just beginning to invest, you can opt out of this scheme because this fund has high risk. And if you really want to invest in a Nifty Bank Index kind of fund, then there are already existing Nifty Bank Index funds with less expense ratio and less tracking error. As it's just new to the market, we do not know what is the proper analysis of the underlying stocks and we do not know how it's going to perform. Without a proper track record, we do not need to take a blind risk. If you really want to invest in a Nifty Bank Index fund, there are already existing ones in the market which you can choose according to your risk profile and your investment goals. If you still have any doubt regarding this or any other financial or investment decisions, then don't hesitate to book a one-on-one complimentary consultation with one of our financial planners through the link given in the description. Also, if you want to know more about finance and investment from leading experts, then we recommend you to attend our live regular webinars for which also you can register through the link in the description, and the webinar is absolutely free. So please feel free to register. If you like this video, hit like, and if you are new to our channel, please do subscribe. We will be back with more such financially beneficial videos. Thank you for watching.